All right, good afternoon, everyone. Let me just set the scene a little bit before we dive into the discussion. So the tech scene in Southeast Asia has been growing like crazy over the last 5 years. Google and Temasek came up with a report last year that I'm sure many of you are familiar with, that the market's going to be worth an estimated 200 billion over the next 10 years. Startup funding last year was about 2.6 billion, up 60% year on year. And there have been like 7 new unicorns over the last 4 years in Southeast Asia. So we live in very exciting times. And as Patrick said this morning, this is probably one of the best times in history to be an ASEAN tech company. But is all of this excitement built on fundamentals, or is it just built on a house of cards? And are we all just riding one big tech bubble, oblivious to the underlying reality that might be less rosy? So to help us figure that out, we have a panel of individuals today that have a wide range of experiences, ex-entrepreneurs, investors, and advisors. So maybe I'll just quickly introduce everyone, and then we'll jump right in. So Khailee, managing partner of 500 Startups, serial entrepreneur in a not-so-distant past. David Gowdey, managing partner, Jungle Ventures, been in the internet space for a long time. Aayush, 11 years covering the TMT space in Asia Pacific. So, quick show of hands, guys. Bubble or no bubble? Up for bubble, down for no bubble? No bubble. No.
Yeah, I'd say no bubble.
No bubble.
I'm incentivized to talk about no bubble. No, I'm kidding. No, but I do believe there's no bubble. So
what about the audience? Bubble, no bubble? Wow, Patrick did a great job this morning convincing you guys. Huh?
But if you think about the original dot-com crash, one of the key tenets of having a tech bubble is that it's got to be unsustainable. And I think if you look at the growth that the region is expecting, and the Google Temasek report, I think was a fantastic report. I think there's an enormous amount of sustainable growth that's coming that's not yet online. And so I think, part of the time when you look at valuations, there's the current market valuation, but then you also have to look at the terminal value of a company and where you think it's going to grow over the longer term. So I think there's a lot of growth that's left to come into the ecosystem.
I mean, on top of growth, like since you mentioned the Google Temasek report, I think another slide in there that's so powerful is beyond just the growth, the opportunity today captured by fundamentals you talked about earlier, GDP. The amount of venture capital allocated relative to GDP for Southeast Asia is abysmally low compared to India, China, and the US, up to 6 times, up to 30 times lower, which means Southeast Asia isn't even investing up to par to capture the value that the GDP, existing today's GDP, offers. So if anything, I think a lot of the talk about bubble has been driven more like media, perhaps, or maybe some other factors, but fundamentals-wise, like it's very hard to build an argument that there's a bubble.
I'll say something, I'll tee you up for a conversation, because you've got all that data. But if you look at last year, I think it was about 2.6 billion that was spent, but I think 80% of that went into 8 companies.
That's right.
And so if you look at the rest of where that capital went, and even if you said, the average A round is, $3 million, you're talking about less than 200 companies getting funded. And even though the ecosystem has raised an enormous amount of capital, particularly in the Series A stage over the last 2 or 3 years, it's still not a lot of companies when you think about 200 getting institutionally backed over the last 12 months out of potential of 3,000 to the Google reports at up to 7,000 startups over that same period of time. So you're talking about 5 or 6% of companies actually getting funded institutionally backed. So, but
I agree with you. Look, I think when people look at funding, they would look at this. There's a sticker shock, right? That X company has raised $750 million, or X company has raised $550 million, and they're burning so much of capital, etc., etc., etc. But if you think about 2 things, one is, how many people were connected to internet in 1999, and how many people are connected to internet today? In 1999, I think the number was about 20 million, and today there's 3 billion. And the fundamental reason for that is smartphones. I have seen the industry change so dramatically in the last 2 years because of less than $50 smartphones coming into market and just empowering internet connectivity and in a bunch of smaller markets or a bunch of underdeveloped markets. So I think that's number one to take care of, to keep in mind. And the other thing to keep in mind is, physical infrastructure is getting replaced by networks, right? So if you look at an AT&T, they've invested $300 billion in their lifetime on physical infrastructure. They make about $200 billion of revenue. So if you look at revenue over total investment, that's about 0.6 times. If you do the same numbers for an Amazon or an Alibaba, you get to a number of 2 to 3 times. And if you do the same metrics for an EBITDA, you get significantly higher numbers for a tech company being able to generate more economic value out of networks and infrastructure. So when tech companies invest in customer acquisition costs, I don't necessarily see that as, of course it needs to be sustainable. Of course it can't be selling your product at a 30% gross loss. But if it is well thought out and if it is well spent, then I think it goes into a larger ecosystem formation, which is extremely important.
I think that's a really good point. And actually, just to follow up on that, because all three of you see a ton of companies every single day. So speaking about sustainability, obviously, one of the signs of a bubble is the emergence of these zombie companies, say in the US, where when times are good, when there's a lot of capital, a lot of companies that not necessarily can raise capital are able to do so because of positive market sentiment, the FOMO effect, everyone wants to get into tech, but not all of these companies that raise capital can necessarily have sustainable business models, or they might have extremely high burn rates that just aren't sustainable in the long term. So in your view, in the experience of all the companies you've worked with and seen with, and some of which you might have advised or invested, how sustainable are the burn rates of some of these companies, or how sustainable are the business models, particularly in this market?
Yeah, sure. Well, that's a pretty general question, first off, right? I mean, how sustainable are the burn rates of all the companies? When I look at investing, I'm obviously for 500 startups, our portfolio is kind of wide. Just as from a data perspective, between the past 2 years, about 500 to 600 seed deals have been executed in Southeast Asia, and 500 Southeast Asia fund called 500 Durians, which I run, has been involved in 120 of them. So I've seen almost 20% of all deals that has been reported publicly. So I kind of categorize the space. You got SaaS deals, you got e-commerce deals, you got all these things. Each kind of business model has its kind of expected burn rates and what's tolerable and a certain expected time for the revenue to make a payback. And some of them, it's very clear. You got certain metrics and benchmarks. But for some of them, which are more maybe kind of in a discovery phase, the expectations are very different. So what I would say is on a general basis, a lot of the conversation around unsustainable burn rates always centers around, again, just a few companies. But when you really look at what investors in this room and all of us are actually investing in, we cannot use the ideas of unsustainable burn rates of 1 or 2 companies in the US, or maybe rumored burn rates of 1 or 2 companies in Southeast Asia, and use that to describe and represent the whole spectrum of other kinds of companies that all of us are investing in.
I mean, I think the other thing to keep in mind, too, is that most high-quality founders are on a path to get to profitability. So most of them want to get away from being in a cycle where they have to continuously raise capital. And so most will think about, the capital that I raise now, how much dilution am I going to take, and then how far is that going to get me? And, can I push some of that capital? Can I push things a little bit further, if I can do this or do that or make that happen? So those are the types of conversations that you tend to look for in founders when you're meeting with founders, is the ones that are being quite dilution sensitive and the ones that actually want to get out of the funding cycle and want to build a business and build it to a profitable, sustainable way. I also think that the dynamics, and I'm speaking tomorrow morning and I'll cover some of this then, but the dynamics of what happens in Silicon Valley is not necessarily the dynamics that happen in Southeast Asia too. And so, whenever you have VCs, we raise money from limited partners who give us money, and then we invest it into companies. And so there's a transparency loop that has to flow back. And I think in earlier stage markets where it's more difficult to raise the capital to have a fund, then I think there's a lot more transparency that flows into that. And so you never want to be in a position where you're putting good money after bad to try and prop up companies or keep them ticking along so you can raise another fund. I don't see that really being happening here. I see that happening maybe in more mature ecosystems where there's a lot more funds, a lot more capital, and just a lot more froth. But I don't see that as an issue.
You always see kind of like the opposite over here. Like a lot of founders here are notoriously tight with their wallets. Like especially a lot of Singaporean kiasu ones. Like so earlier, I think Carousel was on
Singaporeans
stage.
in the room.
Yeah, I know. So Carousel was on stage, so they're notoriously tight with their burn rate, super tight with their wallets. Like they had like raised a lot of internal rounds, right? And then I know their kind of cash position. And I remember they would come and say, "Hey, Khailee, do you have free office space in this country?" I'm like, "Dude," it's like so they're like consistently thrifty, and that's the same for a lot of companies in my portfolio where like I'm encouraging them, look, you've raised the money. Stop trying to earn FD on it. Put the money to work, right? So we have like an opposite problem for often enough.
Look, I think if you look at some of the markets, so Indonesia e-commerce, I would call it a bloodbath because there are 11 or 12 companies out there, the bigger ones who are trying to compete. A couple of them coming into or trying to come in. But I think when you look across certain players, I think what matters is the thinking of the founder, the CEO, of how the burn should be. We are in an environment where capital is clearly a differentiator. So you may have certain plans for your business. You may have certain plans for your business, but if your competitor ends up raising, significantly more capital and ends up being irrational, you have to respond. But I think ultimately it comes down to fundamentals and in specific individuals and specific companies. And to Khailee's point, I think he's right. Some of them are extremely conservative and not as aggressive when it comes to just burning money. Some of them also learned lessons from India. So the smart people that they're not learning from their own mistakes, but they're learning from others' mistakes. And so they often do cite examples of India where valuations and spending got ahead of themselves in certain ways, and that has obviously troubled the market. So a lot of those factors do come into play.
I think the interesting point when you've got like it's good you brought up like Indonesia e-commerce, right? When you have like pockets of over-investment, let's just put it that way, and let's just assume for a moment Indonesia e-commerce is such. There's opportunities to invest in companies that benefit from the overinvestment in one sector. So what's happened with a lot of e-commerce and marketplace is true. There's a lot of money in it, and they are doing a lot of promos and doing a lot of paid acquisition to get a lot of people to use the e-commerce platforms and marketplaces. And so like what we've done is that we've invested in companies which own their own products, who put their products on all of these marketplaces. So one shoe company in Indonesia, for example, called Brodo, when I invested in them, they were just like manufacturing their own shoes. They didn't seem too much like a tech company, but they were making a lot of sales on Instagram and e-commerce and putting their shoes on these marketplaces. Other companies are just doing the customer acquisition for them, right? So they tripled their growth in a year, and they're profitable when invested and still profitable now because they don't need to play the CAC game. They've got other people playing the CAC game too. So following this pattern, like Malaysian diaper company, for example, so and so forth, there are tons of great companies which can benefit from an overinvestment in one sector.
Aayush, actually interesting you bring up India. Actually, that leads to my next point. So down rounds. So I think CB Insights said there were about 106 down rounds last year. I think historically, 95% of investments are up rounds, but I think increasingly there are more down rounds. And we've seen a couple of big ones hit the massive companies in China and India. So Xiaomi, obviously. India, I think Flipkart, Ola. Controversial question. Do you think we'll see more down rounds going forward, and particularly the growth rate, the growth and valuation levels of the unicorns we've seen recently? And do you think we'll follow a similar fate?
I think I probably have a lot more insight into India. And one of the things about India, which I think is also starting to prove out a little bit in Indonesia, is that there was an expectation in terms of the rate of consumption and how that was going to grow over time, which then dictated how capital was getting deployed by some of the larger players in the market. And when the market didn't materialize at the rates that everyone was expecting them to, they were left in a situation where they deployed a huge amount of capital. They, provided a consumer offering which was unsustainable in terms of the level of discounting that was happening and where gross profit margins were sitting. And so I think they've had to retract a lot from that. And one of the things that we've talked a lot about with Indonesia is that it's also crossed, like China did in 2009, crossed $3,500 GDP per capita. But the saving rates are completely different in Indonesia. A lot of the dynamics in the household and where consumption's coming from in Indonesia are very different from China. And so I think you'll see a much slower take-up of consumption online, more like India, probably less like China. And so, whether or not valuations are going to reflect the rate of consumption and how that grows, I think are yet to be seen. But I think that was one of the major contributors to what happened in India.
Yeah, look, I think, the level of activity in Southeast Asia is still fairly early, right? There are 3 or 4 companies that are getting, 2 years ago when I started looking at Southeast Asia, and David may have seen that chart, and when you do a list of investments, it was all bunch of 20 million, 30 million, $40 million type investments and a couple of $100 million type investments. And Softbank invested in Tokopedia in 2014. That was the largest round invested in Southeast Asia of $100 million. Now, if you look at the amount that has been invested, 2 or 3 companies have been able to raise significant amounts of capital. But the pot of gold that they promise at the end of the day is so large that it almost doesn't matter whether somebody was valuing them at $2 billion or $2.5 billion or $3 billion today, because the promise of the absolute return is just so massive that that the percentage change doesn't matter. When SoftBank invested in Tokopedia, it was $100 million, and talk to Tokopedia guys, they didn't know what hit them, literally, right? But SoftBank's view was, if this thing is worth $10 billion few years down the line, then it doesn't really matter whether I value them at $150 million pre or $100 million pre. I'm still going to make $9.9 billion.
I think that perspective is important for people who are commenting about, are startups overvalued? They're not making any profits. How do we even put a multiple on this, right? Because if you're investing for today's profits, the public market has options for you. But if you want to invest in tomorrow's profits, I don't know that there are select public companies which can offer you a very strong promise for that. But if you're really looking at tomorrow's profits, like you said, what's the absolute value of the biggest marketplace across Southeast Asia or the biggest ride-hailing platform across Southeast Asia? How much would that possibly be worth? So I think the lens has to be very different. And I think what's been contributing to the tech bubble story is just people using a very different lens, a very different comparison, which are maybe out of context.
That makes sense. Actually, touching on SoftBank, obviously they've raised a massive $93 billion fund. It's hard to not mention that on stage today. So obviously there's some dissent from VCs abroad, obviously not from Southeast Asia, saying that SoftBank is coming in with this massive muscle power, and they're pumping in big checks at crazy valuations. I think they put money in with Paytm last week. They put in 1.4 billion. I think they pushed the valuation up by 40% to 7 billion. And do you see any concern? What do you think the implications are of that fund for Southeast Asia in particular? Do you think it would push valuations up? How do you think it impact the ecosystem as a whole?
I don't know about you, but they can invest in any of our companies.
I'm just trying to give you my name card. That's all, man. Yoshi, I'm right here, buddy. I got companies for you, dude.
Got to deal with this samurai sword and baseball bat, obviously.
No, but I mean, to give a thoughtful answer to what you said. I mean, let's put this in the larger context over here, right? If you think of how much money has been put into public companies today, and a lot of public companies on the stock market right now, they're having negative growth. So I don't even know, a lot of the EBITDAs, I would argue that there's a public company bubble in many markets. A lot of these companies don't even deserve the EBITDA and the valuations they have. And so if you're someone with $83 billion, am I going to put it across all these public companies? Or am I just going to bet on the future, and how am I going to look at that, right? The world is so different today than it was before. The whole talk about the top 5 most valuable companies in the world all being tech companies, that's a great slide, but that's also a sign that all these SMEs, which will be tomorrow's MNCs, how can they not use digital to get there? if you're really investing in a digital future, somebody's got to, you've got to go at it with the right way. And there's just too many people going at it too meekly. They're like dabbling. They're like, oh, a little bit of this and a little bit of that. You know, how are you going to own a big position of the future? So I really respect what Mahayoshi's son has done. And if you look at the history of him as an entrepreneur, since like the 70s and 80s, like he's always made big bets. And some of the bets didn't work, but he just bets big on what he believes in. And for a lot of us in this room, the reason why we're at Wild Digital, because I think we have a certain appetite for that. That's why we're here. And I think it's important for us to share knowledge, to be very thoughtful about how we're placing those bets, so all of us can do it in an intelligent manner, so not all of us will get completely burnt in all ways. So I guess in short, what I'm trying to say is that I think that blind optimism is very, very bad, but I think that conferences like Wild Digital and having like thoughtful discussions like this gives you a more precise, thoughtful kind of optimism, and I hope that we can sustain this, even though the media would like to tell you otherwise.
Thanks for the Wild Digital plug, Khailee. Unfortunately, we run out of time, so thank you guys for...
No, I'm sure they got some lasting remarks, right?
Do you want to wrap up really quickly? Maybe just a last question, like best and worst case scenario for tech in Southeast Asia over the next 5 years, or the next 10 years. Will we get up to 200 billion?
I actually think that's conservative. So I think it's going to be a lot bigger than that. But I think it also comes to Khailee's point, and actually Patrick had it on his slide this morning. It comes down to how you define things, because I think in the future there aren't going to be tech or digital businesses. All businesses will have a tech and digital component. And so, you know, there will be pure play. If you look at China today, you know, omni-channel, you know, companies, those are very much offline, online companies. And so I think everything starts to merge. But I think the 200 million for this part of the world, I think is going to look conservative in the future.
Look, I agree with that. I mean, if you just look at the consumption expenditure in Indonesia, it's $500 billion. You know, you add the rest of the other, it's a $2 trillion economy in ASEAN, over $2 trillion economy. And 200 billion is less than 10%. You know, with mobile penetration, with almost 100% mobile penetration in most markets, I think that will be the biggest driver of tech adoption. And so, as David said, I think all businesses are going to be tech dependent. There's no tech business per se.
I guess it's a wrap, guys. I guess Patrick was right. This is the best time in history to be an ASEAN tech company.